a lot of Americans don't seem to realize that if they're, I guess, born and raised and get citizenship in the United States, when they become an adult and get older and they go abroad, they have to continue to pay U.S. taxes if they move to Norway or Dubai. Can you tell us about that?
Yeah, so U.S. citizens are taxed on worldwide income as long as they're a U.S. citizen. Here's what's really interesting in the U.S. Let's say you give up your U.S. citizenship. You're still subject to taxes on your worldwide income for 10 years.
Wow.
After you give up your citizenship. So you no longer get any of the benefits of being a citizen. You've given that up and you still have taxes for 10 years. I think earlier this year, we did an episode and we talked a little bit about this unrealized capital gains tax, right? And people don't think, well, I'll just leave. Doesn't work that way. You're still going to have the capital gains tax for at least 10 years. And the only way to get rid of it is to give up your citizenship and wait 10 years. It's a pretty restrictive law because most countries only tax you if you live there. So France, if you're a citizen of France, but you move to Belgium, you're taxed in Belgium. You're not taxed in France. Okay, not true with the US.
Yeah, that's remarkable. I didn't know about that 10-year thing. Even if you renounce your citizenship, those taxes will follow you for 10 years, regardless of where else in the world you live. And you know, Tom, maybe this is a little bit of devil's advocate. I mean, this sounds preposterous when we first think about how Americans are taxed abroad for the rest of their life. But maybe thinking of it philosophically, if it does make sense in any way, which is really hard for me to say, but maybe it's because, okay, well, you were born and raised in the United States where we have this very mature infrastructure and stable currency and good educational system. So you got to be a beneficiary of that. So when you're 30, you can't move away and never give us any tax money to support that again. What are your thoughts with that?
I mean, different countries have different tax systems. What I will say is, just like the state discussion, you do get a credit for taxes paid to another country. So if you have income taxes, let's say you're living in Portugal and you pay Portuguese income taxes, you're not going to pay taxes twice. You're going to pay the higher of the two rates, either the Portuguese tax rate or the US tax rate, but you should not be paying tax twice. Now, if you're going to do that, you need a really good team of tax professionals. You need a good US tax professional and you need a good tax professional where you live. And those two tax professionals need to talk to each other on a regular basis, because otherwise you can end up paying double tax. And that is the worst of all worlds. You do not want to end up paying double tax. So make sure that, just know that if you're going to invest in another country or you're going to live in another country, you need double the tax advice.
Yeah, I am just going to speculate that there are an awful lot of people that don't consider taxes before they move, whether that's domestic or international. Not that that should be the top consideration, but a lot of people probably aren't even thinking about it.
A lot of people aren't. That's true. Now, are there ways to reduce your taxes internationally, particularly if you're in business? Yes, there are ways that you can reduce your taxes. So know that it's still tax planning available. But I hear about people saying, I'm going to invest in the Dominican Republic, or I'm going to invest in Dubai, or I'm going to invest somewhere else. Just know that you've got now two sets of laws that you're working with. You're working with US laws and you're working with that country's laws. And so make sure that you've got good advisory on both sides.
When we're talking about moving for tax considerations, we should cover Puerto Rico. Tell us about the advantageous tax laws for Puerto Rico and if they're going to sunset.
So they're there for the foreseeable future. Okay. So Puerto Rico, depending on how you earn your income, okay, you can potentially reduce your income tax rate from the current 37% rate in the US to 4%.
Yeah.
That's basically an agreement with Puerto Rico. Puerto Rico is still the US, but it's got special laws that it's almost like a treaty, right? Even though it's a territory of the US. And what happens is that if you set it up properly, you've got to live there. By the way, you can't just pretend. You got to live there, 6 months in a day out of the year, over 6 months a year. And if you do, then you get a 4% tax rate on the income you earn while you're in Puerto Rico. Okay. If you earn income while you're in the mainland, you're going to pay tax in the mainland. But the income you earn in Puerto Rico, you're going to pay 4% tax. And there are certain types of income that works for. Certain types of income, it doesn't. So just make sure that this is one where you need a Puerto Rican tax advisor as well as your US tax advisor. Now, capital gains also have a potential tax rate of 0. So there are obviously details you have to follow. So you, again, make sure before you get into that, know that there are huge tax benefits for living in Puerto Rico. No question. It's the Puerto Rican discount. What can I say? We say in Arizona that California has a beach tax and we have a desert discount. So the same was true in Puerto Rico. Puerto Rico has a Puerto Rican discount. That's what it is.
You can watch this one next.